recording as well. Yeah, okay. So I've called it Framework for US Equity Option Trading because you guys are doing, that's the project that you guys are doing. But since the theory that we are learning is general, so I'm going to remove this US equity. I'm just going to call it Equity Option Trading. Actually, this is even more general than that. So I'll put the equities within brackets and make it Framework for Option Trading, okay? So the idea here is that whatever you're learning, this theoretical framework can be used for any kind of option trading, whether you do it in equities, currencies, commodities, debt securities, bond options, or equities, or securities on real estate. So you can use it in any asset class. You can use it in any type, any market. So as I said, very often people ask questions like, why aren't we focusing on the Indian markets? The Indian markets are not liquid. So when you learn something, you should be looking at the most developed market for that type of instrument. So usually the most developed markets are always the US markets. So we are learning it with respect to US equity options, but you can apply the theoretical framework that we are teaching you here, can be applied to any kind of option trading, anywhere in the world. Indian equity options, Japanese commodity options, anything. All right, okay. So, so that's our slight correction in the title of the notes, just to also set the context that this is not something specific. So if somebody tells you, why did we study US equities, not Indian equities, you tell them that this is because Indian equities are not liquid, and it's much better to study the most developed markets, because then you get to know all the different types of strategies and situations that may arise. So you can study with respect to US markets, and then you can successfully trade in India, but the reverse is not true, right? So therefore, that's why we study with research. It's another very unique aspect of the way that I teach the finance electives here, relative to what is taught at other business schools, which tend to have a much more India focus. The reason I do that is because India is not a very developed financial market, so you should not be studying finance with respect to a Indian market context. Then later on, and also remember this time, guys, everybody please remember, I've reminded you once before, that it is your responsibility to take care of the India-related material. I'll make a note of this in today's against today in the session notes. I'm going to remind you guys once again. Today's 25th. Today's 27th. Okay. Please remember this, because this can actually hurt you in your interviews. Please remember, this is your responsibility. I'm not going to do this. That's not efficient to do it as part of your class sessions. Okay. Revise India-related material in your textbooks. Okay. So the India-related material in your textbooks, you'll notice that your 3 textbooks that you will get, all of them have an Indian author, and all of them will have some India-related material. It is your responsibility to go chapter by chapter and find out the India-related material. Okay, so for instance, you will have some material on in the Hull book. You'll have material on Indian derivative markets, etc. Now, this kind of material typically is, as I often say to you, is in the nature of contextual information generally. Okay. It is generally in the nature of contextual information. What do I mean by that? This means that, okay, it will say things like, in India, commodity futures are traded on the MCX-SX exchange. So these are statements of fact. Like in India, people drive on the left-hand side of the road. There is no great conceptual learning here, but you still need to know that in India, people drive on the left-hand side of the road. These kinds of things, this we refer to as contextual information, and it's not conceptual. It's contextual information. It's not conceptual clarity. So you need to have both types of knowledge. These are the 2 broad types of knowledge. So this material is really in the nature of contextual information, like what kind of markets we have in India, what goes on. You need to know this, but this is just kind of in the nature of information. I'm not going to waste my class time telling you that, oh, there are so many stocks listed on the NSE and there are so many stars in the sky. This is just information. So you just read it for yourself and make sure that you're aware of it. But I'm not going to waste class time on this. So class time is for conceptual understanding. But it is your responsibility to make sure you cover all this on your own. And then if you have a question, then you ask me, okay? Because sometimes you may get questions in your interviews that relate to, sorry, there's some background noise. So because of the background noise, I'm just going to be on mute a little bit. I think it's okay now, it's past now. So our topic for today that we will start today is this, payoffs versus profit, payoff profiles versus profit profiles, okay? So this is the topic that we have today, option payoff profiles and profit profiles. So essentially we are focusing on the difference between payoff and profit. Okay, so payoff is like, it's like revenue, okay, revenue, you know, when you have revenue, then you have cost of revenue, and so you have revenue minus cost of revenue is your gross profit if you connect it to the P&L. So payoff is like revenue and premium is like the cost of revenue, okay? And so the profit is basically this adjusted by, that means payoff minus the premium paid is the profit. Okay, so let's look at this. So this is like revenue and this is like what you call, if you look at the typical cost, the typical income statement, you'll have revenue first line, top line, and then you'll have cost of revenue. Okay, so essentially it's more general expression for cost of goods sold, because cost of goods sold is for manufacturing companies. So that's why they have a general expression these days. They call it cost of revenue. So you can apply it even to services firms. Right. So the first idea here, the first concept we are discussing today is payoff profiles versus profit profiles. Let's look at that. So first, let's understand the terms. So profit we are defining very much similar to gross profit on an income statement. So profit is payoff. I've written it as adjusted by premium, but it's actually minus payoff minus premium. Okay. So payoff minus premium. So payoff is like revenue, premium is like cost of revenue. So therefore profit is like gross profit. So this is these are the two important terms. So the first thing you have to look at is, we'll look at some payoff diagrams, okay? And let's look at some payoff diagrams. So these are actually, we'll first look at some profit diagrams, okay? Not payoff diagrams, profit, option profit profiles. So the option profit profiles, you can see here, okay? Option profit profiles, you can see over here in I'm referring to the Hull book, but you can also see it. Okay, this is a bit of a problem, this thing that is hanging around here. But anyway, okay, so you can see it here, this kind of an option profit profile. You can also see it in your, I'm making you aware of another book that is important for your options learning. That is the CME option strategies. There are 25 option strategies listed here. You can read up on it on your own. We will hopefully have time to cover this. This is from what used to be called the CME, Chicago Mercantile Exchange, and now it's just called CME Group. So they have merged with the CBOE and many other exchanges. Here you can find, if you go to long, Simple long call, yeah. If you go to simple long call, it's here. Okay, so this is the same thing. You can find the same thing here. Now let's look at this and see what we can learn. So this is an example of a profit profile. So notice here that it says profit, and you'll notice some other diagrams where it says payoff. So there is an important difference between these two words. We should not use them interchangeably. All right, so profit profile. So understand the basic call option. Once you understand the basic call option profit profile, you'll be able to understand all the other positions, okay? So this is, remember here, this is buying a call, buying a European call, and these are actually both, essentially it's the profit profiles which become clearer, okay? But these are, you should know this term, these are called hockey stick diagrams, okay? So if somebody asks you in an interview, can you draw the hockey stick diagram for a short put position? This is what they're referring to. This is hockey, obviously they are referring to ice hockey. These are the reason these are called hockey stick diagrams is obviously this, you can see, this looks like an ice hockey stick, right? So that's why these are called hockey stick diagrams, because all this option trading theory, these have all emerged from North America, from the US mainly. So those guys play, they are much bigger on ice hockey than field hockey. So that's why when they say hockey, they mean ice hockey. So these are called hockey stick diagrams. That's also important for you to know. Okay. Now understand why this diagram is the way it is. So understand that these are hockey option profit profiles, and these are for specific long option so these are, you can say, these are applicable to the 4 basic types of option positions, okay? 4 basic types of option positions, which is long call, short call, long put, short put. So we'll start with the first one. So remember that this is not just for a call, but it's also for a long call. So you have to remember this is the option position, and not just the option type, it's a position in an option type. Okay, so let's look at this. Why is it like this? So this is your, these are the 2 axes. So here you have the profit figure being plotted, and here you have the terminal stock price. So the other thing to understand is these are, let me write them, these are expiration diagrams, okay? These are expiration diagrams, which means that they apply to the expiration. So obviously options, as you know, can have many tenors. So for instance, here you could have an option, here you have an option with 30 days to expiration. Now, sorry, I did not bring the, I was referring to the Hull book, but I did not bring it into the shared screen. So now you can see it better. And that's why I was complaining about the Zoom menu bar, which was obscuring part of the screen. Okay, now you can see it better. Now you can see the profit profile from buying a European call. And you can also see this book. This you will find in your finance reference, the CME option strategies book. Here you can see the similar kind of profile, okay? It is also showing you the decay of the profile over time. I mean, the decay of the option over time. So this actually shows you that this kind of diagram, this is actually what we call the hockey stick diagram. And this happens only at expiration, okay? Before expiration, it's a different kind of plot. So essentially what you're plotting, in the case we're starting with a long call. And so what you're plotting here is the profit on one side and the terminal stock price. So essentially, okay, did you guys experience a sudden blackout? There was some kind of a problem. Zoom seems to have automatically rebooted. Are you guys there? Can you hear me?
Yes, sir.
Yes, sir.
Okay, good.
Blackout.
Yeah, there was, I saw a sudden blackout at my end and the system, I mean, the Zoom application rebooted, but it's fine. And we didn't have too much of a blackout. So you guys can all see the profit profile of the call option. Okay. So,
No, sir.
No, sir.
No, sir. No.
No, sir.
okay. Now I know because it's rebooted. So I have to share the screen again. Okay. I have to share the screen again. Now I think you're seeing the hockey stick.
Yes, sir.
Okay.
Yes, sir.
All right. Okay. Good. Thanks. So yeah, responding quickly to my questions is very helpful. Okay. So now what you're looking at this. So we are looking at the hockey stick diagrams, and we are starting with the long call option position. And so we want to make sure you understand. I noticed this with a lot of batches that, like we are noticing with a lot of other topics as well, that we cover a lot of very advanced topics, but then in the end, I find that even with the basic topics, people are not very clear. So it's very important that you try to understand all the basic concepts and be very clear about your fundamentals. You see, as say, for instance, Siddharth has been hinting at, we will not have time to cover many important topics in options. Not much we can do about that. I only have 3 courses with you guys, and 60 sessions is not much to cover the whole of finance. So therefore, there is going to be a problem. We won't be able to cover everything, but my goal is to really give you a solid grounding in the fundamentals so that later on you can read the rest of it yourself and figure it out. And of course, you can always call me when you have doubts. Even after you leave the institute, if you have doubts about something, you can always call. So that's not a problem, but we want to make sure that we get the fundamentals right. So it's your duty to be very clear about all the concepts taught in the class. Okay, so understand how this diagram is constructed. So one of the things you have to understand is this is an expiration diagram. Okay, so hockey stick diagrams, these are, when we talk about these normally, as you can see in the option strategies, the CME book, you can also draw them with before expiration, but that's not usually what we talk about. When we talk about hockey stick diagrams, we're talking about at expiration. Here you can see, if you see they haven't given the color coding has been explained at the beginning, I think in the beginning of this booklet. Okay, right. So as you can see here, this is the diagram here. So how do we draw this? It's at expiration. So what we do is for each of these, this is just a straight line. I mean, not a straight line actually, it's a kinked line. But this, the 2 portions of this line are constructed by asking the following question. At expiration, you ask yourself, this is a 100 call. Okay, so remember when we say 100 call or 200 call, we are referring to the strike price. So it's a 100 call. And so with the 100 call, and I paid $5 for it, my option premium is $5. And there's another very important consideration with respect to these, which you should be aware of. Option profit profiles are referred to as hockey stick diagrams in the trade lingo. Then these are for 4 basic types of option positions, which have been explained earlier, so I'm not writing them here. These are expiration diagrams, and let me put plus here actually. These are plus considerations. These are not like this. These are like this actually, but I put this here once, so the rest is all plus. So plus, these are expiration diagrams, and plus, what else was I going to write? Something else I need to write. Oh yeah, okay. These are not adjusted for the time value of money. So these questions might have arisen otherwise in your mind. That's why we are clarifying these points. All right. These are not adjusted for the time value of money. I'm going to make everything. I'm going to bunch it together so that I can, hopefully it looks a little, yeah, okay. Right. So option profit profile, another point is that these are not adjusted for the time value of money, right? So that's why you find that there is no mention here of how many months ago this option premium was paid, because that's not relevant, because we're not accounting for the time value of money. Because if you see, these are expiration, if you look at all the factors together, and if you did not have adjustment for the time value of money, if you needed to adjust for the time value of money, you would have had to ask yourself, because this is happening, this diagram is an expiration, and you would have had to ask yourself, I'll just put some, I'll go into mute, there's some background noise. Or we can just actually ignore the background noise. Okay. So we would have had to ask ourselves, if this is the expiration diagram, and let's say this is a 120-day option. So this $5 was paid 120 days ago, and we are now calculating the whole P&L scenario after 120 days. So we need to adjust for the interest cost of $5 because you paid this $5 120 days ago, remember? So therefore, in finance, when we do these calculations, we have to always adjust for the time value of money to look at the timing differences of cash flows. And so when we compare different cash flows, pluses and minuses, we have to make sure that we are comparing them at the same point of the timeline, okay? So therefore we can't, therefore we have to adjust for time value of money. But what we are making clear about these diagrams is, in these diagrams, we do not adjust for the time value of money. So that problem remains. We don't adjust for it, okay? So now how do I draw this? This is what we do. These two segments of the line come about from joining several dots. Okay, so we have joined several dots and come up with these things. Now, how do we construct each of those? How do we plot each of those dots? So we ask ourselves, I bought a 100 call. At expiration, if this is the terminal stock price, this in general terms we can call it the underlying asset price. Okay, this is the underlying asset price, and this is the option profit profile. Okay, the option profile profit number. So what we ask ourselves at 70, when the underlying asset price is 70, and I'll just call it stock because stock is a much shorter word now. But remember to always talk in general terms, underlying asset. But in this case, I'll say stock because it's such a short word instead of saying underlying asset every time. So look at this. So we ask ourselves, if the stock price is 70 at expiration, and I'm holding a 100 call. So what happens then? In that case, is my option in the money? We can do some further quizzes, and we can ask Mukul, is my option in the money if I'm holding a 100 call and the stock price at expiration is at 70? Are we in the money?
No, sir. The stock price is 70. We are not in the money.
Correct. So in this case, would you exercise the option?
No, sir. We will not.
Good. Very good. So Utsav has raised his hand. What are you saying, Utsav? What is your view?
Sir, same. It is not in the money. We will not sell at this point.
So we will not exercise at this point. Okay.
No, sir.
When I can buy the stock at 70 in the market, why should I buy it at 100 by exercising the option? Okay, so the option is out of the money, and so therefore another way of understanding out of the money is zero intrinsic value, effectively zero intrinsic value, which means if you go through the process of exercising and then squaring the position in the market, you will actually make a loss or you will make a zero profit. So that's a zero intrinsic value situation, which means the option is either at the money or intrinsic or out of the money. In this case, it's out of the money because mathematically the intrinsic value is actually negative. All right, so you don't exercise. So this is how you plot it. And how much did you pay? If you look at remember they are plotting profit, not payoff. We are plotting profit. So therefore you put -5 against 70. You put the dot over here because you don't exercise the option. You let the option expire worthless. So you have minus 5. Okay, so that's why the plot is over here. Now if we come to even to 100, even at 100 we don't exercise because it's exactly at the money. There's no value in exercising because there are certain costs to exercising. Okay, so therefore we don't exercise even if it's at 100. So therefore at 100 also you see the same plot when the underlying is at 100. So these are all expiration scenarios. You plot this graph by asking yourself this question many times. At expiration, what if the underlying, if the stock price is 70? What if it's 80? What if it's 90? What if it's 100, 120, 130, 140? In each of these cases, what is my profit? And I plot my profit. And then I join the dots and I have this line. Okay, so that's how this line comes. So at 100 also, the plot is at minus 5 because we don't exercise and we have paid the minus 5 premium. Okay. Now, can anyone guess what this point is where this line is crossing the x-axis? What is the...
105.
Correct. It's 105. At this point, when the underlying asset is at 105, okay, before we go to that, let's ask this question. Let's say it's at here 103. At 103, okay, should we exercise the option at 103?
No, sir.
Yes, sir, we should.
Who is saying no and who is saying yes?
Sir, Mukul, I'm saying yes, we should.
Sir, I'm saying no.
Okay, Utsav is saying no.
Sir, no from me as well.
Okay, and Ketan has also raised his hand. What is Ketan's view?
Sir, no, sir.
Also don't want to exercise. The person who wants to exercise is Mukul.
Yes, sir.
The rest don't want to exercise. So, okay, so the answer is that Mukul is correct. The reason you want to exercise is because even though, let's think about it this way now. We go back to our your FDRM calc file. We set up a session board. We make sure that we look at, this was 25 November. So let's look at like 27 November, hopefully, yeah. Okay, so if we exercise, okay, so if the underlying asset, if the stock is at, we'll just call it stock. If the stock is at 103, okay, strike is, spelling is not correct. Strike is 100 and premium is $5, okay? So if the stock is, so if you exercise, in this case, exercise and don't exercise, EX equal to 1 and EX equal to 0, okay? So 1, 0, you guys are aware of the computer science hardware concept, how information is stored in computers, 1 and 0. So the statement is true, then we put 1, okay? And so this is if you exercise, and here it's if you don't exercise. So if I exercise, how much money do I make? So I buy, well, let's look at it. Remember, always the profit is exit price minus, so we are assuming that we're dealing in 1 unit, okay? So the profit is, and we are going to assume here that the market lot for trading stocks is 1 stock, like India, although here it's US market, so it's not really 1 stock, it's 100 shares. But we'll assume for this example that is 1 stock. Okay, so remember the formula, never forget this. Exit price minus, the general formula, exit price minus entry price. So what is my exit price if I exercise? What do I do if I exercise? I first buy the stock in the underlying, I exercise my option. It's a 100 strike call. So I buy the stock at 100 and then I sell it in the underlying market, which is trading at 103. So my entry price is 100, my exit price is 103. So in this case, I'm making a profit of, or my P&L in general, we'll soon find out if I'm making a profit or not. Okay, so that's my profit, okay? So you can see I'm making a $3 profit just from this part. But this is not really my profit. This is actually my payoff. So $3 is my payoff. My profit is actually, I have to adjust for the cost of all this, okay, which is $5. So I have to subtract $5. Okay. So my P&L in this case is -2. Now, if I don't exercise, what happens? I don't have this entry price. I don't have this exit price. If I don't exercise means I have just let it go. Understand? So if I've just let it go, I still have paid a premium of 5. Okay, so I will have to take care of this. So therefore, I have, essentially, we should write it as there is no exercise happening. So it is just minus, right? So you can see why Mukul is correct now. Can everybody see that?
Yes,
Sir,
sir.
in that case, we are assuming that expiration date is near.
Yes, sir.
Come again, once again, what are you saying?
Sir, in that case, we are assuming that expiration date is there already. We are at the expiration date.
Yeah. Remember what I told you? One of the things I told you here about this. What did we say? We said that these are, let me put it here actually. What did we say? We said that these are expiration diagrams. Okay, so we'll make it even clearer. Expiration date diagram, which means these diagrams are drawn up this is essentially a scenario analysis on the expiration date. By imagining that you are already at the expiration date, you do a scenario analysis for the expiration date. If the stock price is here, what is my profit here, whatever it is, okay? So this is the entire exercise of the hockey stick diagrams is a imaginary exercise visualizing the expiration date. It's a scenario analysis for the expiration date. Is that clear?
Yes, sir.
Okay.
Yes, sir.
So that's why I've said that these are expiration date diagrams, because sometimes it's not 100% clear everywhere. They don't mention it, so it's not clear. So these are expiration date diagrams. So if we go back to our calculation, so the reason now you can see why Mukul is correct, that anytime you have a opportunity to reduce your total loss by some amount, you should exercise. Okay, so anytime in the case of a call, right now we're doing the long call, but the general idea that you should have in your head is the idea of reducing your total loss, okay, or increasing your total profit. Okay, so if that's the idea, if I have the opportunity to do that, if I can increase my total profit or reduce my total loss in any way, then I should exercise. And so that's why Mukul is saying that we should exercise when the underlying is at 103, because if we exercise, then our total loss is -2, and here the total loss is -5. Okay, so therefore, if I don't exercise, my total losses, I lose the entire premium, and I don't have the opportunity to profit by exercising the option, buying it at 100 and selling it at 103 and picking up $3 payoff. This $3 is the payoff, and this is the profit, because I have to deduct the cost of the option from the payoff. Okay, so is this point clear? Once you understand,
Yes, sir.
once you understand this, you get a good idea about how this thing is constructed. It's important to be clear about the basics. That you imagine, you put yourself onto the expiration date mentally. You imagine all these, and you do a scenario analysis. If this is where the underlying the stock price is finishing, what would be my profit in each case? And then you plot that. And you plot those profit scenarios, profit numbers against the stock price figures, and then you join the dots, and then you get this kind of line. All right. So another thing to note here, if you remember, let me just pull it up here somewhere and then bring it back to you. Yeah. If you remember your asset classes, markets and instruments diagram, the framework that we had used, I'll just bring it up here. Now, one of the things you'll notice is that here we have referred to, so in general in options, we talk about payoffs in a lot of the academic discussions. We don't necessarily talk about profits because essentially, as you can see here, another way to understand the reasoning that Mukul has applied is that whenever there is a positive payoff, okay, so you exercise, so if you look at it, these are not adjusted expiration date diagrams, not adjusted for the time value of money. Okay, so the exercise rule, okay, basically all right, that is the rule, the payoff. So if you see here, it's the same thing. It's a 100 strike call. So as long as the stock price is 100 or less, there is no positive payoff. But the moment the stock price starts to move ahead of expiration of the moment the stock price moves ahead of the strike price, there is a positive payoff and there is an incentive for you to exercise, because with the positive payoff, remember the payoff, the way whenever the payoff is positive, you exercise because profit equals payoff, okay, adjusted by premium. Okay, so payoff adjusted by premium. Okay, now premium can be, if you have a long position, premium will be negative because you have paid the premium if you have a long position. In this case, it's a long call, so premium is plotted on below the zero line, because if you bought an option, that means you paid the premium. If you sell an option, you will receive the premium. So for selling options, the premium plot will be above the zero line. Okay, so in any case, in both cases, if you paid a premium or you have received a premium, in both cases it is always true that profit is equal to profit is payoff adjusted by premium. Okay, that's why I said I didn't write minus premium, because sometimes premium is positive when you're selling options. So that's why I said in more general terms, in more vague terms, I said adjusted by premium. So premium might be positive or negative. Okay. Now let me write that here. Okay, premium. Let's say premium is. Let's be very clear about these things, so that when you're studying them, you're very clear about this. Premium is positive for short option positions and right. So yeah, all right. So the rule is, exercise rule is, whenever the payoff is positive, you exercise. Why? Because profit is payoff adjusted by premium. Let me put this on the side here. Premium is negative, positive for short option positions, negative for long option positions. Okay, in both cases it will be true. Profit is payoff adjusted by premium. So any positive payoff always increases total profit or decreases total loss. Okay, you understand what is being said here? Actually, I could just define profit in a different way to include reduction of loss, and then I wouldn't even have to write this, but I want to just keep it simple and keep it. The language should be in the way that lay people talk. So we're saying any positive payoff will always increase the total profit or decrease the total loss. Okay, that's your goal basically. That's your goal. Positive payoff always increases total profit or decreases total loss. Okay, so since we are all rational creatures, we always want, every person in the world that you can think of is going to want to do these two things: increase the total profit or decrease the total loss. So therefore, whenever you have a positive payoff, this will happen. And so therefore, the rule of exercise is whenever the payoff is positive, you exercise. Okay, so basically that's what Mukul has done. He looked at a positive payoff because the strike, it's a call option, long call, and the question of exercise only arises if you have a long call. And strike is below the asset price, stock price, so you can earn a positive payoff. So therefore, he decided to exercise. Okay, choose this rather than this. All right. So this is the rule. So now you have understood. So once we spend a little bit of time on the first payoff profile, that makes it easier to understand the rest of them. Once you understand all the basics, that these are known as hockey stick diagrams. These are expiration date scenario analysis kind of diagrams. Okay, that's what they do. And so these are not adjusted for time value of money. That's another factor. That's why you write this as -5. Because actually, if you adjusted it for time value of money, it would have to be slightly lower because depending on the tenor of the option. If it's a long dated option, if you bought it 120 days ago, it would be even much lower than if it was a 30-day option, because you would have to add the interest cost of funding $5 for 120 days. Okay, so that would be, so we don't adjust for that. We just write the premium figure. We ignore the time value of money. Any other basic stuff which we should look at, which we have already written? Yeah. So these are hockey stick diagrams, 4 basic option types, expiration date. We should write it like this because you guys are familiar with scenario analysis. So let me, expiration date scenario analysis diagrams. All right. And these are not adjustments for time value of money. Exercise rule is here. We've just explained the exercise rule. Okay. Right. So there's one more point that we have to understand here now. If you see now, if you go back to the framework that I showed you earlier, okay, you will notice that when we look at the asset classes, markets, and instruments, you'll notice one thing, that there are many categorizations here. And one of the things you'll see is that the only instrument which has been labeled as non-linear payoffs is options. Everything else is linear payoffs. Okay. Although derivatives are covering all these instruments, the only derivative which has, or the instrument which has a non-linear payoff is options, and the rest have all linear payoffs. Now, what was the meaning? I didn't explain this and I first showed you this diagram because we had not come to the point where we would be able to explain this. Now we can explain it to see what is meant by linear. So that's what I've written here. Okay. So sometimes we just call them, if you see here, what is it called? I said linear payoffs and non-linear payoffs. And since these are instruments, so you can say these are instruments with non-linear payoffs, instruments with linear payoffs. Okay, so that's what I've tried to clarify here. instruments with linear or non-linear payoff profiles, or even profit profiles. If you draw the profit profiles, it'll be the same thing. I have written payoffs because generally we talk about payoffs because your decisions are based on the payoff figure that you see. Just like you saw here, Mukul deciding to buy because of a positive payoff. And the payoff, so we normally talk about payoff profile, but even the profit profile is non-linear. And sometimes in the market, people just call it linear versus non-linear instruments. So what they really mean is they may just omit the mention of the word payoff or profit, payoff profile or profit profile. So you have to understand that when they say this, they are really referring to these profiles. Okay. So we are looking at this chapter 10 Halbasu, which is here. So you can refer to your book for these. A lot of the material now we are covering now. Most of the material that is original from my side has now pretty much already been covered. Now the rest of the material that we cover now will be material that you can find in the textbook. Okay, so far what we have covered with all the option decision framework, that you won't find in any textbook. You may find it in some of the practitioner textbooks, but it won't be organized in the way that I've given it to you. So now we go into material which is kind of standard options theory, so that you will be able to refer to your textbook for that. Okay, right. So this is the point here. So these are linear versus, so you have to understand now what is meant by. So non-linear is referring to this part. Okay. So this, if it was only like this, it would be linear. If it was only like this, it would be linear. But there's a combination of this. There's a little kink over here. That's why they call it non-linear. Okay. If you want to compare it with linear payoff profile, you can look at this. If you see, futures are listed as linear payoffs. If you go back to your CME option strategies book, I think the first one is a long futures. Yeah. The first one should be long futures. Yeah. So let's understand this also. While we are doing this, this is long futures. Why does this? Of course, you have not done the futures contract. Let's just imagine that you'll notice that spot is also a linear payoff. Okay, so the reason why the payoff profile for spot and futures is not going to be different. Okay, so we have a diagram for futures. We are just going to pretend that this is actually a spot diagram. Okay, so and with that we'll try to understand why this is linear. So this is what is meant by linear. Okay, and this is what is meant by non-linear. That's why options are non-linear, because only options have this kind of profile, and all the rest are linear. Okay, so we'll assume that this is spot. So imagine that this is the price. So here what happens is, this is the price at which you buy the, we'll just call it stock, although in general terms we should talk about underlying assets. Okay, so let's assume this is 100. Okay, we can assume this is 100, or we can, for the sake of parity with this, we can assume that it's 105. Okay, we can assume that it's 105. So here we have 105. Okay, so I bought a stock at 105. So this is the same kind of payoff diagram, which means it is for not adjusted for time value of money. It is a expiration date scenario analysis kind of a diagram, which means it's at for spot, the expiration date is basically whenever you are intending to sell it. Okay, there is no expiration date on spot as such. After the settlement, you can keep on holding it. But this is the date when you're trying to sell it. So when you're about to sell it, you look at you do a scenario analysis, and you think, okay, this, I bought it at 105, and these are all the stock price possibilities. So stock is 100, stock is 95, stock is 90, stock is 85, stock is 80, 75, 70. here stock is 110, 50, 115, 120, 125, etc., etc. So if I look at all these, okay, so and what will be my profit, and this is my profit, okay. So we assume that these are payoff profiles. So we are going to assume that the cost of acquisition it's a 105. Okay, the cost of acquisition is 105. So let's look at the scenarios here. Why is this? Let's look at this. So let's say this is 105, and let's say this is 120. Okay. So here, if we are plotting for 120, what do we have? So the underlying the stock price is 120, and I bought it for 105. Okay. So this is 120 here. If I draw a line parallel to this here, okay, then this part should be, what should it be? If I bought it at 105 and this is 120 and I'm plotting for 120, this one should be, this line should be at what y-axis? What should be the figure here? Anybody wants to answer? Yes? Nobody?
Sir, please repeat question.
Yeah, so if I bought stock at 105 and now I'm doing my scenario analysis, how much money can I make depending on where the stock price is when I'm deciding to sell it. Okay, so maybe the stock price is at 120. So if the stock price is at 120 and I bought it at 105 and I'm trying to plot this graph of my profit profile, of my payoff profile here, how much am I making if I bought it at 105?
Sir, 15.
So I'm making 15. So the point I'm trying to make is that here we should look at 15 over here and then plot it over here. Okay. So we look at 15 here. We draw a line parallel to this, which from at the level of 15, and then here we plot this with respect to the line perpendicular to 120. Okay. So at the intersection of those two lines, we make a plot. So I'm really going for very, very basic plotting. Now, some of you might think this is really stupid because it's too basic, but I just want to make sure that everybody understands how these diagrams are constructed. So there's no doubt, because in the past I found some people who could not even figure out how the diagram has been constructed, which is not a problem. I mean, I'm not saying that in a bad way, because these are all new things. So you need to be clear about exactly how it's done. Okay, so this is how it's done. Similarly, if the payoff, if the stock price, I bought it at 105 and the stock price is 85, okay, then I'm losing $20, right? So the plot here should be, here I take minus 20 from 85, okay, so I draw a line parallel to this from 85, and then I draw a line parallel to this from minus 20, and where those two lines meet, that's where my plot is for 85. And then when I get all these plots, I join the plots and I get this kind of line. So this is what you get with all the other types of instruments: spot, instruments value cash, futures, forwards, all these instruments. Okay. Swaps, all of these, they are all linear instruments. So you're going to get this kind of profile. So that's why we say that options are non-linear payoffs and the other instruments all have linear payoffs. Okay, so this is another thing that you're learning. You should know this terminology. Sometimes people will just say this, okay, but what they're talking about is these two, the profiles. Okay, so that's what. So this is the first basic plot. Now let's go through. So we have understood the plot for long calls, and we have understood the plot for so here we compare with long futures. Actually, we'll call it futures spot, the same thing. Okay. Similarly, you can see also here with short futures, same thing. If I'm short, let's assume it's spot, the behavior is the same. if I'm short the stock at 105 and the stock is at 85, okay, then I'm making $20 of profit. So that's why you see the plot for 85 will be here and this point will be 20. If I'm short the stock at 105 and the underlying asset and the stock price is 125, then I'm losing $20. So therefore, for 125 over here, the plot is for minus 20 over here. Okay, so the short spot, a short futures looks like this. The long futures looks like this. Okay, and this will also help you to understand the other. So you should understand the payoff diagrams for 6 types of positions. Okay, long futures, long and short. Okay, so what we are saying is, so total of, so notice this, okay, so at the end of this module, we should understand, so I'll just go into mute for a while.